Investors in the commodities sector have been whipsawed over the past several weeks. In the energy sector, for example, after rising over 30% after the Russian invasion of Ukraine, the price of Brent crude subsequently fell over 20%, only to rise again in the recent trading sessions by over 10%. So what's really going on here? Let's break it down. Well, the initial rally in oil prices after the unprovoked invasion of Ukraine by Russia was no surprise. Russia is the third largest global supplier of oil behind Saudi Arabia and the U.S. With Russia accounting for roughly 10% of global energy supply, the growing threat of and then strictly imposed sanctions are putting those Russian barrels in jeopardy. And it's happening at a time when the overall supply-demand balance of oil is already tight around the world. So the spike that we've seen following the invasion was intuitive. Less supply, higher prices. So what about the drop? Here's where it gets a little complicated. In order to pay for the higher market prices, many consumers of commodities had to borrow more money for both current needs and for futures contracts. Margin requirements have risen across many exchanges, and volatile markets mean margin calls are more frequent, begetting even more volatility. So what does the future hold for energy? The bottom line is that we can expect commodity prices in general, and oil prices in particular, to remain elevated and volatile. The upward pressure will be felt not only at the pump, but also at the grocery store, given Russia and Ukraine's prominence in the wheat market, for example. This will keep upward pressure on inflation. For investors, inflation protection in the form of equity-based commodity exposure, Treasury inflation-protected securities, and even public real estate investments make sense. Funding goals means protecting purchasing power, so real inflation-adjusted returns matter.